Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 28th of January. I'm Daniel Lam, your host for the podcast. The first month of 2026 is coming to an end. I'm not able to recall a more eventful January compared to this year's in the recent past. The Sell America narrative is once again gaining airtime. But what is the positioning telling us? Actually, the positioning has become much more balanced. Recent selling pressure in US Treasuries has been largely systematic driven, with no evidence yet of broad domestic or foreign selling that underpinned last year's bond market tantrum. CTAs are now more or less neutral on US Treasuries. Speculative Treasury flows over the past week were mixed, with limited signs of macro investors chasing the US 10-year yields higher. In fact, last week's flows point towards more like dip buying activities rather than fresh selling, particularly from domestic US bond funds. So steady demand from these longer-term discretionary investors may explain why recent sell-off has struggled to gain traction. Moreover, unlike last year's Sell America episode, there has been a lack of broad selling across time zones, particularly in Asian hours. This is yet another key difference that may explain the more contained Treasury market sell-off last week. Further positive macro surprises and a higher term premium argue for upside in longer dated yields. Now, this risk are partially offset by dovish tail risk from Fed rate cuts and the prospect of a government shutdown. So at this moment in time, we see potential mild downside to US 10-year Treasury yield. As for the other asset classes, the short yen squeeze has pushed US dollar positioning even lower to the 15th percentile. Further downside in the dollar requires fresh catalyst, so therefore there now risk of a short squeeze in the US dollar. Finally, the positioning on US equities has held steady over the past week, with the initial CTA deleveraging offset by institutional and retail dip buying. So all in all, there's no alarming development of a strong Sell America narrative at this stage. We believe the environment is still pro-risk, and much will depend now on the announcements from the heavyweight US mega caps later this week and in the following week. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.